Hey investors, welcome back to Markets Analyzers. If you are new here, don't forget to hit that subscribe button and ring the bell so you'll never miss an update. Today we are diving deeper into our series on stock investments. Last time we talked about evaluating growth potential. Now let's take it a step further and dig into sector and industry analysis. This is going to be super useful for making informed investment decisions. So let's jump right in. Alright, let's start with the basics. What exactly are sectors and industry? Think of sectors as broad categories of the economy. For example, we have technology, healthcare, finance, and so on. Now, within these sectors, we have more specific groups called industries. So, under technology, you might have software, hardware, and biotech. It's like peeling an onion layer by layer. Imagine the economy as a giant tree. The main branches are sectors, and the smaller branches are industries. Each leaf on those branches represents a company. Understanding this structure helps us see the bigger picture and make better investment decisions. Now, why should we care about sectors and industries? Well, understanding this helps us in a couple of big ways. First up, diversification. By spreading our investments across different sectors, we reduce risk. Imagine if you had all your money in just tech stocks and the tech sector takes a hit. Ouch, right? But if you are diversified, a big dip in one sector won't hurt you as much. For example, if you have investments in tech, healthcare, and consumer goods, a downturn in tech sector might be offset by gains in healthcare or consumer goods. Secondly, it helps us spot growth opportunities. Some sectors might be on the rise due to economic, technological, or demographic trends. And finally, risk management. Some sectors are more stable, like utilities, while others, like tech, can be more volatile. Let's break down the key factors that affect sector performance. Economic cycles. Different sectors perform differently at various stages of the economic cycle: expansion, peak, recession, and recovery. For instance, consumer discretionary sectors tend to do well during an expansion when people have more disposable income. On the other hand, during a recession, defensive sectors like utilities and consumer staples often perform better because people still need basic services and goods. Technological trends. Innovation can make or break a sector. Think about how the smartphone revolutionized the tech sector. Companies like Apple and Samsung thrived because they were at forefront of this regulatory environment. Government policies and regulations can have a huge impact. For example, the healthcare sector can be heavily influenced by changes in healthcare laws and regulations. When new laws are introduced, companies in this sector may need to adapt quickly, which can affect their stock performance. Consumer trends. Changing consumer preferences and drive hinder growth. For example, the rise in health consciousness has boosted the organic food industry. Companies like Whole Foods have benefited from this. Let's take a moment to look at the electric vehicle EV industry. This industry is a part of larger auto sector but is driven by specific trends, environmental concerns, and technological advancements. Companies like Tesla have surged because their EV. Now let's talk about tools. How do we actually analyze the sector rotation strategy? This involves shifting our investments based on the economic cycle. For example, during a recession, you might want to invest more in defensive sector, healthcare, and during a recovery phase, it shift towards cyclical sector, consumer discretionary, and industry. ETFs and mutual funds. These are great for gaining exposure to specific sectors without picking individual stocks. For example, if you believe the technology sector is going to grow, you could invest in a technology ETF which holds a basket of tech stocks. Industry reports and news. Staying updated with industry reports and financial news is crucial. Trustworthy sources can provide insights into sector performance. Websites like Bloomberg, Industry Specific Pub are good places to stop. Financial ratios. Key ratios like profit margins, return on equity, and debt to equity ratios can give us a snapshot of a sector's health. For example, a high ROE might indicate that companies in particular sector are efficiently generating profits from their equity. Let's break this down with an example. Suppose you are interested in the renewable energy sector in India. You might look at an ETF like ICICI Prudential, Nifty 100 ESG sector leaders. Read reports on renewable energy trends and analyze financial ratios of top companies like Tata Power and Adani Green Energy. Let's bring this to life with a real-world example. Imagine we are looking at the Indian IT sector, specifically Infosys. The IT sector has been booming thanks to digital transformation trends. Infosys, a major player, has been performing well due to its strong management and innovative solutions. By comparing Infosys with its peers like TCS and Wipro, we can see how it stands out in terms of revenue growth, profit margins, and return on equity. This kind of analysis helps us understand whether it's a good investment. For instance, if Infosys has a higher return on equity compared to its peers, it might indicate that the company is more efficient at generating profits from its equity. Additionally, looking at growth rates in revenue and profits can help us gauge the company's future potential. So, how can you get started with your own sector and industry analysis? Research. Look into sectors that interest you. Use resources like financial news websites and industry reports. For example, if you are interested in the Indian pharmaceutical sector, check out reports from companies like Dr. Reddy's, Cipla, and Sun Pharma and read up on the latest healthcare trends. Stay updated. Keep an eye on the market trends and news that might impact your chosen sectors. Set up alerts on financial news websites or use apps that provide real time updates. Diversify. Spread your investments across multiple sectors to manage risk. Don't put all your eggs in one basket. If you are invested in tech, consider adding some defensive sectors like consumer staples to balance your portfolio. Analyze. Use financial ratios and compare companies within the same industry. For example, if you are looking at the FMCG sector, compare the profit margins and return on equity of companies like Hindustan Unilever and ITC. Let's say you are interested in the consumer goods sector. You could start by researching companies like Nestle India and Britannia. Look at their market trends, financial health, and growth prospects. To wrap things up, sector and industry analysis is a powerful tool for making informed investment decisions. It helps with diversification, spotting growth opportunities, and managing risk. Make sure to dive into the research, stay updated, and diversify your portfolio. In our next video, we will be talking about how to identify undervalued stocks. So, stay tuned for that. Thank you for tuning in today. If you found this video helpful, don't forget to like, comment, and subscribe for more insights on navigating the stock market. Hit the bell icon to stay updated with our latest updates. Don't forget to follow us on other social media handles as well. See you in the next one.